Welcome to Excess Returns, where we focus on what works over the long term in the markets. Join us as we talk about the strategies and tactics that can help you become a better long-term investor.
Justin Carbonell and Jack Forehand are principals at Validea Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Validea Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validea Capital.
Hi guys, this is Justin. In this episode of Excess Returns, Jack and I sit down with Anupam Ghosh, co-founder of System2 Advisors and sub-advisor to the new Simplify ETF that focuses on investing in India. We talk with Anupam about the Indian economy, some of the recent political developments there, the growth of India and its attractive demographics. We then get into stock picking with him, what he looks for when buying stocks for his concentrated portfolio of Indian companies, how he assesses management, his definition of a moat, and much more. This conversation uncovers some of the unique things investors should consider when investing in emerging markets. As always, thank you for listening. Please enjoy this discussion with Anupam Ghosh. Anupam, thank you very much for joining us today. We appreciate it.
Thank you.
Where are you actually sitting? Where are we talking to you from?
You're talking to me from Mumbai, India. Generally, I'm based out of Summit, New Jersey. I do come to India about between 3 and 5 times a year. So it just happened that I'm in India, and the election results, et cetera, were all during the time.
Yeah, that's we're going to get into that. But Jack, I think out of the almost 300 podcast episodes we've done, I don't know, this might be a first direct feed to India, right?
Yeah, no, I think it is.
So we are going to talk to you about investing in India, the Indian economy, what makes it unique, what maybe some of the risks are, and how you go about building portfolios that consist exclusively of local stocks in the Indian market. And I think for our audience and investors, which tend to be mostly US, we all have a very strong home bias in our portfolios. And I think, probably for the last 10 to 15 years, that has served many investors very well. But I think international diversification and thinking about this type of thing and understanding the differences in these countries and the differences in how the companies may operate is important to kind of, tease out, because they are different countries. India is a different country, has different growth and demographics, stuff we're going to talk about. But I think this is going to be a good sort of discussion on, investing in India and kind of even at a higher level, international investing and how you go about thinking about it, given that you've been doing this for, most of your career. So to start, let's start like high level with the Indian economy. Can you kind of, give us sort of the big talking points? How big is it? How fast it's growing, and sort of what makes it up?
So the GDP today is about $3.8 trillion. And in this financial year, it's expected to grow 8.2%. It has grown approximately 6% a year over the last 10 years. And if you look at estimates for growth, so in the next 5 years, 10 years, etc., all the estimates vary from about 6.5% to about 7.5%, 8%. Now, just in the context of this is if you go back 20, 21 years, the GDP was 500 billion. Today it's 3.8 trillion. So it's been compounding at a pretty steady clip. But we believe now that because of, you mentioned the word demographics, because of the demographic dividend, that growth is going to accelerate. And essentially for the next 2 decades, we'll see some pretty impressive growth. In the context of it's important because in the last 5 years, India's overtaken both France and the UK to become the 5th largest economy in the world, after the US, US, China, Japan, Germany, and now India. If you look at the most optimistic estimate for growth for Japan, the most pessimistic one for India will overtake both Germany and Japan in the next 3 to 5 years and become the world's 3rd largest economy.
So very strong growth. Does the economy tend to have more, like I think of the US, since World War II, recessions have kind of been less and less as our economy has gotten more mature. Is the business cycle in India a little bit quicker than a more established firm, like maybe you have in or established country like you have in the US or in Europe?
Justin, difficult question for me to answer. The reason why it's difficult to answer the question directly is that India still has, but till recently, there's a massive parallel economy or a cash economy, which effectively made a lot of, economic statistics very difficult to gauge, et cetera, et cetera. So, you could have stuff going on in the formal economy, which is not reflected in the cash economy, and vice versa. So, and again, I mean, a lot of the numbers regarding recessions, et cetera, were very, very sketchy. It's only in the last, I'd say about 10 years, that statistics have become much better. And with all the reforms that the government put in, where India is largely a cashless economy, and you never feel that till you take a ride in a tuk-tuk on the streets of Bombay and you can't pay cash. You stick out your mobile phone, he has a QR code, and the money changes hands. And street vendors are paid that way. It's I mean, there's still cash, that goes around, but, the digital infrastructure calls for a cashless economy. So a lot of the economy now is formalized, and, we've just seen good growth now for the last 10 plus years. So last 10 years, we really haven't seen anything which would resemble, the type of business cycles that we've seen in other parts of the world.
And what in your opinion is driving that growth? I'm thinking, there may be some demographic differences between India and the US and, other things that make you positive on India.
So Justin, as I said, I left India to do a PhD in economics, Fordham University in the Bronx, love the place. Enrolled in the PhD program in 1990. My wife, who I met in India, was the only one of the class of 1990 actually got a PhD. But while the primary driver is demographics, and while economists have a very arcane sort of, jargony type of definition for exactly what the demographic dividend is, it's to do with dependency ratios and things like that. I have a much simpler and more pedestrian way of looking at what the demographic, dividend is, which is pretty much when you have an economy where the per capita GDP crosses a very low threshold, like $2,000, sort of, basic human needs, calorific needs are met, and discretionary consumption sets in. You demand a $500 phone, $1,000 TV, $10,000 car. That sets off discretion, consumption that essentially takes, per capita GDP from $2,000 to $6,000 in a straight line. Translates to 2 decades of 10% growth. The last time we've seen this movie is in China, 1995 to 2015. It's just a fact of, economics and fact of, demography. The average age in India is 27 years old. 27 years is the average. You've got half the country below the age of 24. So, here the dependency ratios make a lot of sense. If you look at the average age of China, it's 10 years old at 37. If you look at the average age of Japan, which is absolutely the basket case as far as demographic goes, it's 47 years old. Now, to think in an advanced country like Japan, one of the most beautiful places on the earth, I had the pleasure of spending 3 weeks in the summer with my family there last year on vacation. I've been there on business plenty of time, but first time I went on vacation. To think that a quarter of the population is going to disappear over the next 10 to 25 years. It's just amazing. But what the one-child policy in China is going to do to its demographics is going to make Japan look good. Because they're going to have a lot of very old people very quickly without any young people to support them. In the United States, we are sort of fortunate because of migration to the United States that keeps the country young. We look at the Social Security system, and I see all three of us, probably in the second half of our lives. Maybe. Now, I've been paying into the Social Security system, just like you guys have been, since I started working in 94. Now, the Social Security system, the Social Security in the US is a Ponzi scheme. We need young people to come and start working, contributing to it, so that older people can get paid. Problems come when you don't have enough young people contributing for the older people to get paid. Problems happen. So in the United States, because of migration, we are extraordinarily fortunate that the demographics remain in favor of the country, unlike most xenophobic countries like Japan or European countries or other countries where the demographics are poor, including places like Russia, etc. So in India, average age of 27, very young population, working age population, and my version of the demographic dividend that I gave you is probably what's going to take the country forward the next 20-ish years. 20-ish years. There are a couple of other things which are quite important. The digital infrastructure that the country has, between, the system that was implemented probably about 8 or 9 years ago, and it's been in the works for a while, where, using, a single method of KYC, AML, using a retina scan, a 8-digit number and a thumbprint, everything is digitized. You can open a bank account, instance. Now, the reason why Modi is as popular as he did, when he got into power, in 2014, using, the digital infrastructure, he got 500 million bank accounts opened. And the reason was that, it's not it's reality, India is, welfare state, where, the poor have to be supported because they vote for the governments, But not unlike the US, where you have all these transfer payments, in subsidized grain and all kinds of subsidies, but most of it gets siphoned away by the renter class. What Modi said was, if I instead of giving someone rice at, this price, if I give them the cash, I can't see how they're going to be cheated out of half the rice. Let them go spend the money how they want. If you look at, the amount that the US government spends on poverty alleviation, below the average per family that's spent is $40,000. Section 8 housing, SNAP, Medicaid, all the other good stuff. They add it up. It's about $40,000 per family that's spent by the government on poverty alleviation. If you give them the $40,000, they're above the poverty line. However, you got, the renter class, Section 8 housing owners, and all the other, people who support the different parties, who need them on the flesh. So what Modi did with digital infrastructure was completely modernizing it, where all the payments are electronic, and supported by the uniform payment interface, which is, built by the government for, for the people. There are, I forget the exact number of how many transactions happen every day. But unlike the US or in most of the world, where the payment networks are Visa, MasterCard, American Express, none of that exists. I mean, they exist in India, but all the payments are electronic. Completely free of cost. So besides the demographics, the digital infrastructure, extraordinarily important. You can apply for a credit card, and virtually get a credit card and start using it within the hour.
It's interesting. In many ways, they're ahead of us on a lot of this stuff. They're ahead of the US.
In certain ways, yes. In certain ways, yes. And then sort of, you've got, it's a democracy. And while, we always say that democracy is always messy, always problematic, etc., still ahead of, most other forms of government, definitely preferable. And the reason why I say that is that probably dictatorships are better for economic growth than democracies are. But in democracies, you need to have, at least the appearance of distribution of wealth. Because if not, you're going to be voted out of power. So you do see enough transfers, happening that at least leads to a certain amount of distribution of wealth in India. Even though, in the last, I'd say, 10 years, the income inequality has absolutely ballooned. But, you've got 138 people on the billionaires list. That's because economy is booming, markets are booming, and you got to produce billionaires. So between, the digital infrastructure, the demographic dividend, and democracy, these are the pillars on which, the economy is moving forward.
We're going to get into the Indian stock market in a second, but we're recording on June 5th, and the Indian election just happened, as you mentioned. And I wanted to ask a little bit about that because it seems like the results were a little bit unexpected. I believe the Indian market had its biggest decline since 2020. I believe it was down 6% on this. So I just want to get your overall take. Can you just talk about what happened in the election and why the market reacted like that?
So, Jack, once the polling was done, which finished on last Sunday, which was on the 2nd, polling was done. On the day after polling, the official, not official, but, the various exit polls came out, which suggested that the Modi government would have a comfortable majority. That's what the polling numbers suggested. When the actual results were tabulated yesterday, and as sort of the vote count is, you can see it almost live. The key thing was that the Modi government and the alliance that heads up, there are 3 or 4 other parties involved with the alliance. They have a comfortable enough majority. The lower house of parliament, is 543 seats. You need 272 to rule, to form the government. The alliance got, about 292 seats. Now, this is in stark contrast to, the 400 seats that Modi was touting that he was going to win, or the alliance was going to win. And, all the polls basically suggested anywhere from 310 to 330 seats. And they came out to that. But, Jack, the major issue was Modi's party, which is the Bharatiya Janata Party, BJP, which he belongs to, the last 2 elections has had, 280 plus seats. So they could be a majority by themselves. In the current election, they got 240 seats. So they need the opposition, they need sort of the alliance partners to basically pull in with them to form the government. And that leads to sort of, horse trading and, what sort of, ministries are going to be given over, to, there are 2 key parties, that need to be now appeased, And the question now is that how much of the very aggressive agenda that Modi had is going to basically be tempered down. That's why on Monday, when the exit polls were out, the market is up quite a bit. I think it was up like about 3%. Yesterday, when the polling, actual poll results started, it fell about 6%. Today, it's up about, I believe, 2.5%, 3% of again. It bounced back today because the fear yesterday was that some of these key alliance partners could be lured away by other people to try and form a government, and leave Modi out. But by the end of yesterday, both the key alliance partners pledged their allegiance to Modi and said, we're not entertaining any other offers. We're going to stay with the alliance.
Let's shift to the Indian stock market. I have to admit, I don't know a lot about the Indian stock market. Those of us in the US, we know the S&P 500. We know sort of how it breaks down. We know the NASDAQ. We know all that stuff. But I don't know a lot about the Indian market, what the indexes are. I mean, I've heard about the Nifty. Can you just talk at a high level about the Indian stock market, how big it is, the major indexes, like the high level things people need to know?
Sure. Jack, not a small market. The market capitalization of, the Indian stock exchange or the stock market is in the region of $5 trillion. So I believe that makes it the 5th largest or the 4th largest, somewhere there. I mean, Hong Kong is pretty big. It keeps shifting between Hong Kong and India. But about $5 trillion. The major indices of the Nifty, which is a capitalization weighted index, like the S&P 500. However, there is a older sort of price weighted index like the Dow or the Sensex. And the Sensex has been around forever. The Nifty came in much, much, much later. The total number of listed companies are 5,400 companies, which are in the top 10 companies in India by market capitalization make up about 22% of the total market cap. Now, why that's important is the top 10% of the top 10 companies in the United States account for 31% of the S&P 500. So the concentration in the US is much larger. Now, if you look at it sector-wise, in the US, 30.5% of MSCI US, just to make comparisons between MSCI India and MSCI US, which is the right way because methodology is the same set. 30.5% of the companies, in the US, in the IT sector, compared to 10.6% in India. In India, the biggest sector by market capitalization are financials, which is 24.7% compared to 12.8% in the US. Financials dominate the Indian market. Otherwise, just to walk you through, what the others are, like consumer discretionary, 13% compared to 9.9% in the US. Energy, 10.7% with 3.9% in the US. Industrials, 10.4%, gas, 8.8% in the US. And it's pretty sort of, it's pretty, evenly distributed after that. Materials are 8.4% versus 2.4% in the US. Consumer staples are 7.6%. Again, it's a fairly diversified stock market compared to a lot of other countries, including China, which is very, very sector sort of concentrated compared to India. A broad range of sectors.
At a high level, how do valuations look in India? I mean, in the US, everybody's talking about how overvalued the market is, and particularly the market cap weighted indexes. Like, do you have any feel for what the valuations look like in India relative to history?
India trades on the Nifty 50 on 1 year forward earnings 18.9 times, which compares to in the US it's 20.7 on the S&P 500. MSCI India, which is a broader index. The problem with the Nifty is that it's 50 companies, market capitalization weight, it's got a lot of, very highly concentrated, market heavyweights. But MSCI India, which is about 140 names, that trade has a lot of the smaller or the consumer dominating companies that trades 23.1 times earnings. Now, 23.1 time earnings is at a significant premium to other emerging markets. Most other emerging markets are at 10, 12, 13%. India's always traded at a very significant premium to other emerging markets and that is sort of, as money is sort of poured in the country, that has further exacerbated. Now, just to give you some sense there, Jack, if you look at India's share of the EM basket, in the MSCI ACWI sort of construct, that has gone up very steadily from about 5% about 15 years back, I believe, or 20 years back, almost 20% today.
Wow.
So if you look at India's weight of the EM basket against China, they look not too dissimilar, but China's economy is approximately 4 to 5 times larger than back then. So, those are some of the reasons why, it appears very expensive. Now, consumer companies, et cetera, look very, very, very expensive, only because people are betting on consumer growth. All the consumer-driven companies are formerly expensive, PE-wise. Now, Jack, the other comment I'll make is very simply this, that everything that we're talking about is more classical Western methodologies of, discounted different sort type modeling, that's done. And it's typically, 5 years of, forward-looking earnings, and then some terminal value being assigned, and that continuing at that. Now, in India, the companies have got clear growth paths for the next 20 years. Now, if you apply, just what are traditional Western methodologies of different discovered type margins to some of the Indian companies, not all, some of them, you get extraordinarily expensive rates. While if you see that they can grow for the next 20 years because of various reasons, I'll give you an example, stock that's in our portfolio. Now, as sort of, the consumers began to dominate, the conversation in India, every major consumer brand is in India. Every major one. Like, in fact, I was quite surprised almost 7 or 8 years back that the second Tom Ford store in the world was in New Delhi after the one in New York, I believe, which kind of surprised me a little. But if you look at all the major sneaker manufacturers, every major brand is in India, whether it's an Adidas or a Puma or a Nike or you name it, they're all here. The prices for these sneakers are global prices, around $70 per pair, the average. Now, only about 30 million people can afford that at $70. There's an Indian sneaker company called Campus Shoes, which produces sort of, their own branded sneakers, which we believe are not maybe as good enough, but they're sold at $10 to $12. Now, if you just look at poverty alleviation in India and sort of the number of consumers that are entering the lower middle class, et cetera, this company probably has growth for the next 20 years. If you apply, the traditional 5-year dividend discount model and some terminal value, you get earnings which are, you get PEs which are in the hundreds, for it. But if you look at it over, a 20-year period, you say, let me say you're not that expensive. Now, the example there is Unilever India, fast, a consumer goods company, Indian version of the Indian affiliate of Unilever. If you would apply, the traditional, valuation metrics that we talked about to Unilever, in 2005, you'd be out of there by 2010. It's continued to compound at 15% a year from then on. So India, on the face of it, looks expensive. It's always been expensive. We believe there are reasons for it. And, the methodology is just one of them,
What is the relationship of like the average Indian investor with the stock market? I mean, are they investing in the stock market? The people that are investing in the stock market, are they using index type products like most people here do in the US? Like, how does that work?
Sure. So let me just go back to some context. It's very important. If you go back just about 10 years, maybe a little more than that, 10, 15 years, typical family balance sheet, family wealth allocation was between real estate, physical gold, and certificates of deposit. Because you had blue chip companies that in the relatively high inflation, has always existed in India, relatively. The US has started making India look pretty good now, which were giving you sort of a 12, 13, 14%, annual yield. Blue chip companies, that's what people invest. These are like, my parents' generation, Now, obviously not healthy. A lot of money was parked in real estate. The Modi government, in its very first term, essentially reformed that. They made it very difficult to have any sort of cash component. Let me explain that. Because there's a high stamp duty, a large portion of the value of an apartment would change hands in cash to avoid the stamp or to avoid part of the stamp duty. They came in with reforms that made it extraordinarily difficult for any of that to happen. And suddenly the parking of cash in real estate essentially went away. And, not to pick on China in any which way, I am a fan of China, but you look at what housing is doing to China, where it's exactly the same problem. See, Jack, unlike the developed Western world, the Eastern world, is a low trust society where we believe in tangible assets, gold, real estate. Paper assets, not as trusted yet. Now, when Modi came in, he realized to broaden and deepen the capital markets, you need to get people investing in the stock market. So gold, which is India is the largest consumer of gold in the world, because for intergenerational transfer of wealth, etc., it is the most convenient way of doing it. India, I am, good Hindu. Yeah, I say that. Well, the Hindu religion, there's a particular day, during our New Year, which is Diwali, where you're supposed to go out and buy gold. In the US, we go and buy an ounce of gold every year. I bought it as low as $230. I paid as much as $2,400. But we have a stash of Krugerrands and maple leaves and all kinds of combinations. So gold is just a traditional investment. Now Modi came in, a lot of the gold into India, because of high duties, etc., was smuggled into India. Modi made that very difficult, very difficult. Now, if you go and buy anything which is worth over 25,000 rupees, which is $300, you need to have your tax ID papers with you to be able to buy anything like that. That essentially put a stop to all this. So everyone naturally, and as interest rates came down, these blue chip certificates of deposit were no longer an option. So the only option became the stock market, and Modi's government encouraged, small savings into the mutual fund type business that goes in there through a dollar cost averaging type plan, which I call SIPs here, the monthly saving plans. And this is like, everything from $2 to $10 a month. When you have 100, 200, 300 million people doing that, that provides a lot of a put into the markets. So, but it's a relatively recent phenomenon. This is not ever a traditionally sort of a form of saving. Obviously now a generational change where sort of a lot of stuff in sort of middle class, upper middle class buy looks not that different from London or Hong Kong or New York or Dubai or anything like that. So there's generational change going on too, where paper investing is perfectly fine. So we are seeing the early parts of the Indian populace getting involved in the stock market. And Jack, I'll also point out that if you went back probably about 5 years, 10 years in the Indian markets, the foreign institutional investors, were the dominant force in the markets. If you want to explain why the market's going up, you say, FPIs are buying, the foreign portfolio investors are buying. Why is it going down? Foreign portfolio investors are selling. Today, they're not nearly as important as domestic institutions. So the focus has changed quite a bit because of these plans, where small savers are putting in, $2 to $10 a month into mutual funds. So your second question, Jack, on indexing, and there's never been a traditional indexing here whatsoever. That's the explanation that I have for that is that if you look at the indexes, the heavyweights in the index are, IT companies, or pharma companies. India didn't have much of an IT sort of, business till the Y2K problem came about, and Indian companies got involved in reviewing code and fixing the Y2K problem, etc. Now you've got 5 IT companies which are in the $100 billion type market cap range. But if you look at these companies, even though they're Indian companies, their operations are based largely in India, manpower comes from India, their markets are in Europe and North America. So what sort of determines, their revenues, etc., the factors that move them and weight them are much more outside of India than within India, like the exchange rates. Similarly, when IT itself is like a 120, $130 billion a year type of export from India. Pharma companies, if either of us, take any generic medication in the US, because of our insurance companies or whatever, it's most likely, the medication was actually, made here in India. India has the second largest number of FDA-approved manufacturing facilities after the United States. But generic pharma, which is again a huge business in India, heavyweights in the index, are much more influenced by, reimbursement policies and insurance policies in the US or in the UK, et cetera, et cetera. They're not domestic players. So that's why I think active management in India is always, work, because most people, if they think they're buying the index in India and getting exposure to what is desirable in India, is consumer growth, they're getting none of that. Only the financials are the heavyweights in the index that are part of sort of consumer growth in India. Two of the biggest companies in India, which are both over $100 billion, are oil companies. India doesn't control the price.
Sure.
But they've got a 10% weight each, in most of the indices. So, Jack, there just has never been a sort of a low-cost indexing Vanguard type model here at all. I believe that, low-cost indexing, et cetera, are more features of truly developed and very efficient markets, which India is not.
What's interesting about your approach is you've decided, a lot of times when you look at funds that invest, for U.S. investors in emerging markets, you'll see you'll see index type stuff, but you also see very, very diversified funds. And you've decided to run a very concentrated fund, which I think is really cool. And it's similar. That's to what we do in the U.S. What made you make the decision to run a very concentrated approach?
So again, some history here, Zach. The primary focus that we have on India, we have 4 offices here, about 80 some people in India, 4 offices here. Our primary business is hedge funds. We run a large market neutral business focused on India, which we've got a long history. One of our family office investors in 2020, essentially asked us the following question. They said, hey, India was economically very, very weak going into the pandemic, unlike the rest of the world, which was sort of, cranking at full speed. So we believe that India, he's the family officer in Hong Kong actually, they said, we believe that India will bounce the hardest coming out of the pandemic. How should one play India? Should we play beta? We said, no, we believe it should be active managed. I said, do you have an actively managed product? No, we don't. Can you build one for us? And says yes. And that's what caught us in that business. We wanted to be completely index agnostic, sector agnostic, and say we want to focus on the primary driver of growth in India for the foreseeable future. The dominant factor there is, consumer discretionary spending. And there are other ancillary things around what's driving the markets in India. But the primary one is, consumer discretionary growth. And most of our sort of, portfolio was around that. We believe that, if you have, when you really, in a market like India, you really cannot have a 2-name portfolio, even actively managed, and be that much better than the index. You're almost the index. So in order to have truly active management, you got to be almost, in my day, I may be a still proud investor in the Janus 20 funds. You just had 20 names, and they were high conviction, highly concentrated, large bets. So we said, the size would be managed long only in Indian bonds. So, we said the ideal portfolio should be between 20 and 40 names. No more than that. But, we believe in things like active share, in absolutely no, correlation to the index whatsoever. Because in India, we believe it is possible to beat the index quite consistently. that we've shown in the last 4 years of managing the operating platform.
Just one more from you before I hand it back to Justin. Can you just talk about your process in terms of how you get to your portfolio? So I would assume, you said I think there's 5,000 or 6,000 companies in India, but I would assume your investable universe is a lot smaller than that in terms of the companies you would actually invest in.
Out of those 5,400 listed companies in India, I wouldn't go anywhere near 5,000 of them. So we start with extraordinarily simple and extraordinary, just in liquidity and market cap type of filter, and liquidity and market cap type of filter. And that automatically takes the 5,400 names into about 800 names. Then we apply some, sector specific factors and some other quantitative filters, which are sector specific, etc., which takes the names down from to about, 250 to 300 names. And then what we do is on those names, we apply, what we call a 4-pillar system. First we look at, business moats. We look at the quality of management. We look at sustainable growth. We look at industry growth, things like that. And that takes the numbers down to about 70 or 75 names, which we believe is our investment universe. Then we do a much deeper dive on these names. We build our own valuation models. We talk to the management, do sort of channel checks, visit production facilities, et cetera, and then essentially come up with a portfolio of 20-25 names.
How do you go about assessing the quality of management? Some investors kind of shy away from talking to management because they think they're always going to get a good spiel. For other investors, particularly, I think strategies like yours that are really going active, they tend to, I think, talking to management and trying to assess management quality is important. So just generally, how do you think about that? And then how do you assess it?
Sure. So Justin, just a little bit of context there. India is largely, almost all the companies that are public were family-owned companies at some point. And to go public in India, at least 25% of the outstanding shares have to be in the public float. A lot of companies, are dominated by the founding, families that own, anywhere up to 75% of the company. And, the moment someone has 75% of the shares, you have to be very, very certain they can pretty much do what they want, unless you're very, very sure that. So we look at things like, allocation of capital. How efficient is that?
Mm-hmm.
And I'll just give you a crude example there. There are conglomerate type tendencies in India, like in the rest of the emerging markets. A family that's in, just given any business here, assume it's some consumer good, son goes and studies computer science in the US, comes back and say, hey, why don't we start an IT business for the shit? And they start allocating. Now, the moment you see that, and they have no underlying expertise in that business, that's a misallocation of capital. So we look at that. We look at, what they essentially give you as guidance and how true is that guidance. We typically need, for a company to get full weightage with us in our portfolio, at least a 5-year track record of being a public company. That means 20 quarters of financials, and we are constantly comparing, what is the management outlook, what exactly is transparent. Typically, the very rosy outlooks you get, you're only disappointed. The realization is way shorter than what was promised to you. So we look at how close is that correlation, and how close is that correlation. And the other thing is that that managements typically in young public companies, they react quite differently, to being a public company than when they were private. So we need to see enough seasoning in that and make sure that, that the management is, we obviously look at, family ties. If, the son is a CFO and the, daughter is the this, and it's completely family controlled, and it's not what we call more professional management. You look at, what is sort of the credentials of the C-level suite, how independent is the board, things like that. Because in our portfolio, where we essentially, we have to be comfortable holding the stock for between 3 and 5 years. If you don't have, sort of management that you can put your trust in, holding the stock for that long is not, you will get bitten by a lot of things. So you have to be very sure management quality is pretty good.
I think that explanation was an excellent example of why having an understanding of the different cultural aspects that are sort of embedded in these companies in different countries is so like strategically important. So that was really excellent. Thank you. I find the family like ownership thing, here in the US, like these founder run businesses, many of them that are public that still have the founders at the helm, and you can kind of name them, you kind of start with Berkshire Hathaway, look at Facebook, Google, they have these unique ownership structures to some extent in some cases. You can see, you could see the benefits of that, but then you can also see the downsides of it as well, as if it's being taken advantage of, and if decisions are being made that kind of put the family ahead or the owners ahead of shareholders. Yes. Excellent. So I wanted to also ask you, I know, as part of your process, you like to look for, and you kind of touched on this sustainable growth and sort of a competitive moat around the business. So how do you go in your investment process? How do you go about sort of trying to uncover that?
Sustainable growth, we look at, the segment of, whatever industry that may be, what is the addressable market and how many new consumers are coming into the market. They're just in, the Indian consumer is sort of, evolving quite rapidly as they have sort of the wherewithal to essentially, and there's sort of, the factors which are extremely important is as, families have enough sort of, spending power, they want the best for their family. So we look at sort of the phenomena of, essentially getting the more premiumized goods and more, especially in package segments away from, the generics to more the brand names, So, we see, certain segments there, which essentially are in the in the industry, which is deemed, fast moving consumer goods, which essentially the addressable market looks massive, looks absolutely massive. And as, as more consumers are coming into the low middle class and middle class, their preference for higher quality, brand name goods is much higher, continues to grow. Then, there's some unique sort of features of the Indian market, and I'll give you one of them, infant formula. Example, you cannot advertise infant formula in India. Whatever the quirk is. I don't know the history of that, but it's always been that you cannot advertise infant formula. Now, some of the bigger Western brand names, which manufacture in India, etc., like Enfamil and Similac, etc. As people can afford them, they gravitate from local brands into these brands, and these brands have an absolute moat around them because they're deemed high quality, aspirational brands, and which, are not susceptible to advertising, things like that. Now, just a little bit of history then is, in 1970s, 75, the only 1.5 years of India's 75 years of independent rule, which there was martial law in India. And, essentially, under the Indira Gandhi government, foreign companies that were operating in India either listed in India or they left, or they left the country. A lot of companies like IBM and Coca-Cola refused to list here, and they were ejected from the. However, a lot of other companies decided to stay, like Procter and Gamble, like Colgate Palmolive, like Unilever, and they all went public here, also for at least 25% of their stock and in the public market. Now, so Procter and Gamble, I believe it's the only listing for Procter and Gamble outside the United States. So it's a quirk of the market, and as well the historical context is important. But the baby infant formula thing I talked about is both publicly listed companies here. No one can touch them as far as I know for a while. At some point they may be able to change it, but catch up to a very, very well established, global brand like an Enfamil or a Similac or something like that is for a difficult job. So the Nestle's and the Unilevers, they dominate some of the premium, sort of fast-moving consumer goods. So there are lots and lots of examples like that you sort of figure out that that this sort of this brand is unassailable, and the moat is around it for various different reasons. And then just like every other place, India is also a hugely aspirational society. So there are local brands which are also aspirational and command quite a bit of a premium across them. There are certain, business houses. Tata is one of them, which is extraordinarily, the consumer in India has got very, very high regard for the Tata brand. They've been it's a very large conglomerate, everything from, sort of automobiles to, to tea, to all kinds of stuff it does. When they do own, Jaguar, Land Rover. But Tata's name is hugely, sort of trusted. There's to manufacture and distribute a watch brand called Titan, which they further expanded to jewelry, and that is amongst the fastest growing, and trusted, publicly owned sort of jewelry distribution in India.
I think it's interesting that as a society sort of moves more and more to that aspirational sort of want or need and seeking that, that those moats can kind of be around those. I mean, a strong brand name is a moat, and it almost seems like it's even stronger moat in societies and cultures where you're having this migration towards more and more the aspirations. The company is moving up, people are moving up, and so as people move up, those aspirations become even like stronger and more sort of powerful, I think, possibly. Wanted to ask you about position sizing and sector concentration. It seems like, your portfolio, it's completely bottoms up. And I would imagine your biggest positions are in your most, are in your best ideas, but just talk about that. So the portfolio holds somewhere between 30 and 40 stocks. What might be the largest position, and do you care at all about sector concentration, or is that not even a consideration?
No, Justin, even though the overriding sort of, concern is, exposure to the Indian consumer and other factors that are moving the Indian markets, the consumer being one of them, we do have in portfolio construction and risk management, fair amount of guardrails that we've put in. The first one is very simply that no single stock, it can be more than 10%, weightage at cost. If it becomes 15%, we will review it again to see whether it still holds. And 20% is the absolute upper limit. We will not exceed 20%. Right now, our biggest name is 8%. It is 8%. Now, what we also have is, Justin, for very, deep dives that we do into the stock and our own valuation models. We have a 1-year target and a 3-year target for the stock. And, sometimes we are surprised to show that, a 1-year target is better than 6 months, stock is down. In our little under 4 years of managing the portfolio, we've had as many as 4 stocks double. So that poses a little bit of a challenge and dilemma. I mean, is there further growth potential here, or has it been all front-loaded? Should we essentially trim this in our market? We do have, sort of, we don't want more than 30% concentration in any sectors, and we further break it down. And more importantly, because of conglomerates in India, we don't want any single founder-led company, founder-led crew to have more than 25% exposure in our portfolio. So those are the various ways in which we look at, that we look at running a more diversified portfolio rather than, if you have 3 stocks in your portfolio, are you really sort of a portfolio at all?
Right. Yeah. We want to make sure we're sort of balanced here. So if I'm an investor looking at this and I say, this all sounds great. You got growth in the market. We got active stock selection. We're looking for moats. We're looking for companies that we can see clear growth in. What are the risk considerations that all investors should be thinking about with a strategy like this?
Sure. Absolutely the biggest risk factor, we believe, essentially growth being derailed in India. That could happen, for a variety of reasons, both, internal and external. And internally, we feel that, if consumption does not keep up and become more concentrated, that could be a problem. And let me just give you the context here. Approximately 52% of India is rural, or 50-some% is rural, while and are largely involved in the agrarian economy, while agriculture is only 17% of GDP. So you've got rural consumers, you've got, urban consumers. But, in a democracy, again, you have to have a rural vote to stay in power. So there's always, so we think that if for any reason, and because of very large concentration of the population, we're still not, urbanized and live in rural consumption, if that sells off, that could be a problem. And the biggest problem with, agriculture is that about 80% of agriculture is dependent on the monsoon rains. You have poor monsoons, you have poor rural consumption. So the rural-urban consumption and the balance between them, what the government does to keep that in check, that could be a factor, a risk factor. That could be a big risk factor. Political stability, which is one of the very attractive features of India compared to most EMs, emerging markets. With the latest polls, and the latest results from yesterday, that's not as clear now. Do we expect this government to last 5 years? The answer probably yes. But if some infighting breaks sets in within the coalition partners and the government is toppled, we may have a problem. Those are more internal problems. External problems, geopolitical risks are always, are always there. I'll name 2 of the biggest ones. One is India is highly dependent on food imports. Oil is a huge import for India, and a huge import for India, and sort of crude prices have a direct, impact on the Indian economy. And according to work that we've done in Germany, India is very comfortable, or we think the Indian economy is very comfortable with crude up to about $105. Below $105, and it's comfortable. Above $120, it then becomes inflationary and starts, biting into growth, et cetera, et cetera, et cetera. So, price of crude is, and India's been somewhat fortunate that, in spite of, the 2 wars going on, one in the Middle East and one in Ukraine, that price of crude has stayed relatively benign. Relatively benign. The last sort of risk factor, Nate, is we are in a pretty nasty neighborhood. On northwest of us is a failed state called Pakistan, which is nuclear armed. India's gone to war 3 times with Pakistan, and it's a nuclear armed state, which is essentially a failed state, which India's constantly had problems with. And we share, I believe, a 11,000 kilometer border with China. Out of the 11,000 kilometers, almost 2,500 kilometers is disputed because of, So, India's gone to war with China just once in 1962, but there's low grade warfare going on all the time. People shooting across the border. Could it clear up? But a war with China is unimaginable, but a distinct possibility, a distinct, it's not a zero probability. It's a positive probability.
I think those are, fair and honest points that just investors need to know about. We like to ask all of our guests a standard closing question, and that is, based on your experience in the markets, if you could teach one lesson to your average investor, what would that be?
And the only free lunch is diversification. That's pretty much it. That's pretty much it. If you have a well-diversified portfolio, you're in good shape because that's the only free lunch.
That's great. Anupam, thank you very much for joining us. Really appreciate it. If investors want to learn more about you and the new ETF you have with Simplify, where can they go to learn more?
They can go to Simplify's website and look under ticker IOPP, India Oscar Bond.
Excellent. Thank you very much. Really enjoyed this conversation. Best of luck with the fund and the strategy. And, we, I think, like to have you back on in the future to get an update on the Indian market at some point, down the road. So thanks so much.
Justin, thank you for having me. It'll be my pleasure. Thank you. Take care.
This is Justin again. Thanks so much for tuning into this episode of Excess Returns. You can follow Jack on Twitter at @PracticalQuant and follow me on Twitter at JJCarbonell. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. We appreciate it.
Justin Carbonell and Jack Forehand are principals at Valydia Capital Management. The opinions expressed in this podcast do not necessarily reflect the opinions of Valydia Capital. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Valydia Capital.